Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun going over a thought-provoking comment. And so this is based on the AMC video that I did yesterday. Now, there was a very nice comment. There's been a number of very nice comments, and one of them was very thought-provoking and was a little bit critical, forced me to think a little bit more critically. And so I responded in kind of a lengthy comment. And I wanted to go over that with you guys. And also, one of the things I did want to mention is one of the reasons why it does sometimes take me a while to respond to comments. I do try to respond to all of them. That is because some of them make me think a lot. And some of them are critical, whether it sends me down a positive rabbit hole or a darker rabbit hole. And, I've heard that a lot of people encourage don't check the comments. But I disagree with that. I think, one of the great things about this channel that I try to encourage is that it's about community. We share ideas, and just because I have a YouTube channel does not mean that, there should be, any weight given to my views. I'm just another retail trader. I just happen to enjoy communicating by making videos, and also it does force me to be accountable in my thought process. And with this comment, I did respond, and I thought it would be worth sharing with you guys because it really gave me a good idea. And also, I should note, if you guys do comment on a video and this one does perform well, I might, do videos on comments and my responses just to encourage the community interaction and to give you guys voices on this channel so it's not just me going on about my random thoughts. But yeah, I'm really excited about this one. And also, this is somebody that does comment frequently. And so I do appreciate the engagement with you guys because, there is, even though it's just via the avatars and our handles and stuff, there is a really nice personal connection there. So I just want to say I do appreciate the, routine engagement and stuff. So thank you in advance to that. But yeah, I'm just going to go over the comment. I'm going to get the thumbnail out of the way, which is the video. Link in the description, including the AMC playlist, along with a lot of other playlists. And let's see, I will also try to include a link directly to this video in the pinned comment down below. But yeah, let's go over this. This is just kind of my view zoomed in on YouTube Studio. And this comment comes from JRR. And yeah, he comments on pretty much every AMC video that I do. So thank you for your thoughts. And for this comment, I, was initially thinking about responding. Well, it's good not to listen to people on the internet, whether that's me, whether that's you, whoever it is. But it forced me to think more critically because there is more to this. And I think that one of the things that, whether it's the AMC community or just retail community in general, we tend to kind of fall in this trap of buy and hold, buy and hold. But that doesn't do one thing, which is kind of create chaos. And I think that's what we want to be doing. That's how we get things to go up or down, very rapidly, is by creating chaos. And buying and holding is very predictable. And so this kind of forced me to think more critically about that. Related to options, I think this is a really intriguing idea. But options are risky. You can lose all of your money on them, whereas shares, you always still have them. Doesn't matter what the price is at unless the company goes bankrupt, all of that. So none of this is an encouragement. This is just me being excited about an idea, being, critical of myself thanks to you guys, giving me some feedback. And so anyways, I'm just going to read this and I'll insert little thoughts along the way. But so JRR writes, love your videos, Ed, thank you. I hope you buy a few more shares because, like you said, these prices are a gift if you are long on AMC. And so with that being said, I was kind of thinking, in the video, I guess I should say, I was talking about, that shares being really cheap. But for me, it's like buying more shares. It just really hasn't done that much to me. I'm not really getting my average down that much. So it's not something that really excites me. And am I long AMC, in the position? I would say that I am, of course, yes. But I feel like, following 2020 and stuff, just my experience going to the movies, interacting with people at work who are younger than me, and or going out with women who are younger than me, and being like, let's being excited about going to a movie or something. They're just not. It's like the younger generation is not as excited about the movies, and yeah, so I think that's something to. I think I'm a little bit more excited about like AI and crypto and stuff like that. I think you kind of get the sense and energy. I think you kind of get the sense from some of my other videos and posts. But anyways, I'm just going to continue on. Sorry for the tangents. But since the dilution last December, JRR's brought his average down from 550 to 450. So I think that's great. That's awesome. In the video that I put out yesterday, I had talked about my averages between two exchanges is somewhere between 8 and 10. And at this point, I don't feel like I'm really going to be able to get my average down that much. But I think that there might be a strategy that's kind of revealed in my thought process that I'll go over with you guys now. And so here, the too long didn't read is I'm going to make a video about this and put it out. It'll probably be out shortly. I'm recording this about 1:30 Eastern right now, so it should be out before 2:30, I imagine. But yeah, so I just congratulate JRR. Nice work on the lower average. It's always great to celebrate people's accomplishments and to encourage people to, be doing what they want to be doing. And also, that is a notable impact, getting the average down that much. At this point, personally, I don't see myself getting my average down significantly lower, as I already have more shares than I want given its performance and opportunity cost. And the opportunity cost, this is going to be different for everybody. But for me, my personal experience, there are two things that I feel like I got burned on, and I'm not bitter about them because I learned from them and I'm happy for the outcome. But, following 2020, 2021, all of that, I changed career. I actually didn't necessarily change careers. I left my career because, looking back, really because of like DEI stuff, but I left in a positive, being optimistic. After having done that, looking back, maybe I'm a little more bitter about that. I don't know. That's just a reality of it. But anyways, left that. And from the 2020s, early 2020s, I guess, got into a number of stocks, one of them being AMC, GameStop, others. Palantir was one of them. And I was very confident in Palantir. But then I got to a point in my life where it was like, I can't be, in all these positions. I need to focus on other things. And I regrettably, but lesson learned, sold basically the bottom on Palantir. And that is one that, I really believed in fundamentally. And that's just been a great performer. I was previously swinging it a little bit, and then it went up way higher than I expected. And yeah, that's kind of been a big disappointment for me, because the reason why I sold that is because there wasn't as much of a community around Palantir as there was around AMC. And so I wanted to stick with this. And this was before I was doing the YouTube channel and stuff like that. And that was a bad decision, because AMC price has gone down, Palantir's gone way up. But at the same time, I think that there's something to take from that, in that, when there's community, it makes these things easier. It makes them more enjoyable, more fun. But at the same time, another word for community is herd. And what, is in herds? Sheep. What is in packs or in prides? Lions, wolves, And so that's what we want to be like. And so I'm not bashing the AMC community or anything like that, or any communities around any stocks, but I just think that's something really important to consider, because that was a bad decision on my part. But I accept it, and I've learned. And what I've learned from that is I've had a lot of conviction in Tesla for a very long time, a lot of conviction in Elon Musk, and a lot of the people in my personal life have hated him, have hated Tesla, all of this stuff. And what I've decided to do is I've decided to tune out that noise. I now have a position in Tesla. It's very small, but I'm very proud of that. And that's something that I'm not going to let go. Why am I not going to let go of that? Because I fundamentally believe in the company. I fundamentally believe in Elon Musk. I think that collectively they're making lives better. They're making the world better. And, I want to be a part of that. And the hard lesson that I learned from Palantir is then applied into that Tesla position. I don't ever want to sell those shares because I believe in it. And so I think that's a good lesson to take from there. Also, another opportunity cost is when Bitcoin was dipping in the tens to 20s of thousands or whatever. I had some cash on the side and I was thinking, well, AMC's cheap. I think Bitcoin's going to go to 12K, which bottomed around 15. And I was waiting for 12K. At that time, I will pounce. But until then, I'm going to go in on AMC. I'd be up a lot more money had I sold AMC, had I held Palantir, had I bought Bitcoin when it was in the 10s and 20s. But that's the past. We got to learn from our experiences, and that is part of the opportunity cost. And but then we have to see what are we doing with the decisions we made in the past and moving forward. And so, yeah, I mean, those are, I feel like, my two big opportunity costs with AMC. And yeah, but I think things might be changing. And so I'll talk about that as I continue on. But adding small amounts, and this is kind of like my thesis with every investment, adding small amounts does add up over time. So it seemed like a nice compromise. In the video I talked about just basically adding one share a day at the previous day's low. And, that worked out. I got 5 more shares last week. But let's continue on here. Another factor is that I could realistically see a wick up to about $10. I talked about it in the video. And I think, getting up to 20, getting up to 30, I think that's a little far-fetched, at least, in the time horizon and the frequency that I make these videos. But I think that 10 seems feasible. I think it could get, bumping into something around 5, especially if people's averages are around 5. People might want to be trimming there. That's going to result in some resistance. So think about that. But, realistically, I could see a wick up to around 10 like we saw in May of 2024, which might be short-lived like it was in 2024. And so that would be allowing me the opportunity to trim, not selling all of my position, but trimming some at break even and or above to get my share count down to a number I'm more comfortable with. And then I'd feel more comfortable adding more lower and or holding longer without emotion. So I think that's a really important thing. If it's whether bills are looming or other opportunities are being missed out on, I think that's something that we all need to weigh. And I don't think that we should be shaming people into selling or trimming or whatever it is. If we want this to be a sustainable, healthy community, we need to celebrate each other's wins, whether that's getting averages down or trimming so people can don't want to highlight all of that, manage their emotion as well as manage risk, because these are real things. The stock market is risky and we all have different emotions. We all have different financial situations. For one, I feel like I'm very fortunate in that I don't have, family, partner stuff, kids, pets even. But at the same time, I think that's a little bit of an unfortunate thing because those are nice things that do fulfill people's lives. But then that also makes the risk a bigger word and it makes people a lot more emotional. But, we all have to manage that individually and respect each other's decisions on that. But then, thinking about that and that, emotion, I guess I should probably leave that highlighted for this. My failure to act, and, that is to say, I didn't even trim a little in May of 2024, hangs over me because I had that, I think it's 1145. It was a previous wick high. I had that level marked and I didn't trim. And that, because let's see, I'm just going to finish what I had. My failure to act in May hangs over me because I had it on the chart, but greed and hope got the best of me. But I even, I had this exchange with somebody on X about, my being happy about this could be marking the top. And that in fact did mark the top. So, for me, I don't like selling all at one level. I like trimming in and out or, DCAing in and out of positions. That works for me and my emotion. It takes a lot of the emotion out of it. It's just, based on lines on the chart. But, that hangs over me because I could have bought a lot more. I could be buying a lot more now. But, that leads into the next little paragraph here, or next little sentence. I'm not sure where I heard this. I watch a lot of YouTube videos. I'm sure we all do. And this is one probably related to Bitcoin. managing risks, stuff like that, how Bitcoin recently topped, it's pulled back a lot. I think it's going to go higher, so I have conviction in that, whether it's long-term, short-term, whatever, it doesn't matter to me. I like Bitcoin. But, in relation to that drawdown that we've recently seen, not sure where I heard this recently, but every trade has two transactions, and we oftentimes focus on the first, which is buying. What's the average? What do we get that fill at? And we completely neglect the other, which is selling or trimming, which is, trimming is to manage risk. So one then has capital on the side to then buy back lower and or to just take some of that emotion out of it. And so, I am kind of thinking about with AMC at the lows, in my view, I want to see, where do I want to start to lower my risk if it does go up? I need to have a plan for that exit. And so continuing on, what has captured more of my interest regarding AMC is accepting the fact, and this is in my opinion, that my $20 January calls will be going to zero. And I did talk about those in the video from yesterday, but those are ones that I started building a position in about a year ago. And I just don't see the price going to 20 by January. Maybe it goes up to 10 or 15 or something, and maybe that brings my premium cost for those contracts to break even, and I could exit. But I'm not so convinced of that. I don't think that they're going to be expiring in the money. I think that they're going to be expiring worthless. So I kind of want to manage that. And so, thinking about those, do I accept that now and do nothing, that they're going to go to zero? So let's think about that. Let's think about that as far as risk management goes with the clock ticking. January 2026 is around the corner. And so I did get that $5 January 2027 call earlier in the year when it was above $1. So that's $100 per one contract. And I talked about that in yesterday's video. And now seems like the time to get my average down and effectively rolling the 2026 call into it. So my answer is no. Maybe I worded this poorly, but I was writing this on my phone. The comment got me off the couch thinking about things and making this video. And so just thinking about this, if I see that this contract could be going to zero, maybe it does, maybe it doesn't. But I could at least sell at a loss at 5 cents, which is $5. And then I could roll that. I talk about that down here. I guess I'll wait to get into that. But just thinking about this to explain this a little bit better, I think that the 2026 expiration in January is a little too close for comfort for me. That affects me emotionally. That affects me psychologically. And I think that it could be going to zero. And so my answer is no, because I think I can utilize the capital that I have in this one and roll some of that, effectively roll it into this one, which I talked about in the video from yesterday. So just going down what I've written here, I could accept selling that contract at 5 cents, was just mentioning that, to at least walk away with something. So, I think I got 50 contracts, so that's $250. So I'd be walking away with $250 rather than zero. After having risked $700. So, that sucks, but it's not nothing. It's or nothing if it is not. So if I place a limit sell order at 5 cents, I then walk away with $250, so that's more than nothing. And then I have that capital to explore other things, whether it's with the AMC or other stocks, crypto, whatever it is. And so that seems like another good compromise. I think it's all about compromise, and we need to be thinking about that. I think compromise in life is just generally good. But, now back to shares in that 2027 contract. I'm just thinking about it. If I'm losing conviction at lows and not aggressively buying the dip at 2, and that's not necessarily to say that I'm losing conviction in AMC, which I feel like I am to some extent, just, given what I've talked about, movies and, the younger generation not really going to theaters and stuff. But let's see, if I'm losing conviction at 2, and it's just like, I've bought it when it was low and it just continued to go lower. So I guess, if I started to see like a green weekly candle next week, maybe, I would say, well, it's at 250 now, which is max pain. So, maybe it's going to start to go up. So, getting at 250 is still, cheap. I want to be seeing that the bottom is actually in signals. But, just adding to my share count, I don't really feel like I'm getting my average down. And so, I'm just going to continue to read this again without interrupting myself. If I am losing conviction at lows and not aggressively buying the dip at $2, I am likely falling into the trap of chasing FOMO and buying higher, which is no bueno. And so, yeah, if I'm not buying at 2 and then it breaks out to like 250, then I buy at 250, but then it pulls back to like 180, I didn't do that well. But I think that there might be a better option, pun intended. There might be a better way to play this. And so what could be bueno is considering exercising the $5 calls that expire in 2027 when price wicks up to 10, which would create buying pressure at 10. And so that's one of the things that I think we miss when thinking about options. Like, let's say I think price is going up to $10. If I buy calls with a strike of $10 and it tops at $10, if I don't sell those contracts for premium once it's gone up, that doesn't necessarily give me any leverage as far as shares go, because if price goes up to 10 and I have contracts with a strike of 10, I could exercise them and I'd be buying shares at 10. Or I could just buy shares at 10. It doesn't really give me leverage other than with that premium going up from, price being around 2 to price being at 10, that premium goes up. I'd have to sell them, but then those contracts could be going to 0. So what I think is important to think about with contracts is to think about ways to create buying pressure at that level that we might be seeing some resistance at. And so while also trimming shares to manage my risk and emotion. And so I'm just going to, I guess I'll just read this again, trying to not interrupt myself. I'll read this entire little paragraph here. So what could be bueno is considering exercising $5 calls when price wicks up to 10. Volatile move up to 10, exercise calls creates buying pressure. That would create buying pressure at 10. While also trimming shares to manage my risk and emotion, because I'm an emotional being, I've got risk, I got to take care of myself, And so also as a reminder or an alert to exercise the calls. So let's say, however many shares I have, if my average is between 8 and 10, I'd be taking a little bit of a profit if I trimmed at 10. And so let's say I place a limit order to trim some shares at 10. That gets executed whether I'm at work, whether I'm in a movie, whether I'm busy, whatever it is. That gets executed. I see that. It's like, oh, crap. I just sold some shares. Now that's a reminder for me or an alert that I need to exercise that $5 strike call. However, I think, let's continue on here. However, I believe that could be balanced. The selling pressure by me, selling some shares, trimming some shares to manage risk. That would then create selling pressure. However, I think this is an important point. I believe that could be balanced by cluttering the order books for market makers, creating chaos for them, and possibly sending the price even higher. Or, sort of like a gamma squeeze. Not necessarily exactly, but, if price is going up to 10 and we have shares that we want to sell at 10, that's going to push price down. But if we have contracts with strikes at 10 and price goes up to 10 but tops there, then those contracts decrease in value and there would have been no benefit in getting them if to exercise them would be at a higher price at 10 when we could just be buying shares at 2. But what I think could create some pressure for it to go to the upside even further is if it does go up to 10 and contracts are exercised that have a strike of 5. And I'll kind of give a thought experiment example of that, which, I'm really excited about this because it includes managing risk as well as managing position size. Whether that's adding, decreasing, or keeping the same. And I think that it does create bullish upward momentum. So I'll just go through this with you guys. And so for every 50 shares sold at $10, so let's just pull up the calculator here, just so you guys can see what I'm talking about. For every 50 shares sold at $10, so that's 50 shares sold at $10. That's $500. Okay, very simple math. Let's just keep that in mind. One contract could be exercised at the strike of $5. And so I'll come back to that with the calculator, which would increase my share count, but would not lower my risk. So for every 50 shares sold at $10, so 50 shares sold at $10, I'd have then $500 in my account. And then that $500 could be exercised at the strike of $5. And so options contracts are based on 100 shares. So this $500 based on selling 50 shares could then effectively be rolled into buying back 100 shares at $5, because $5 times 100, I don't even need to do the math in the calculator. It's so easy. That's 100 shares. So that would then be increasing the share count, but would not lower my risk. I kind of want to lower my risk a little bit. And so here's a continuation of that thought experiment. And so for every 100 shares sold at 10, and so this is 50 sold at 10. So let's do, 100 shares at 10. So I'm just going to change this math up here. 100 shares sold at 10. Oops, crap, I'm getting ahead of myself. Every 100 shares sold at 10. That's $1,000. Easy math there. One contract could be exercised at a strike of $5, which would cost $500, which would leave my share count unchanged. So I'd be selling 100 shares at 10, and then while price is still up at 10, I could then exercise one of those contracts to get 100 shares at 5, which is higher than the price is right now. Of course, I get that. But this does something. It creates chaos, 4D chess, which would leave my share count unchanged. So I'd still be holding the same number of shares, but I'd have some cash on the side because I'd be selling to get $1,000. I could then be buying back those 100 shares by exercising a call, and then I'd have $500 in my account. And so that would leave my share count unchanged while lowering risk by taking profits or trimming. I'd still have shares, and that would be at or above my average. So, this seems like a strategy that would really work for me in lowering my risk, taking some cash out of AMC, but not really changing my share count. And, you can do this in a variety of ways. These are just two examples. This is one, which would increase my share count, but I would not be exposed to more risk. This is one that, let's see, I would leave my share count unchanged, but then I'd have some cash out. So this is intriguing to me, and or potentially, don't get mad at me, I'm managing risk in the way that works for me, potentially be bringing my share count down a little bit, but also have some buy pressure in there because I would be, selling some shares, but then I'd be exercising. And so that, kind of exchange is more dynamic than just I'm going to buy and hold. It creates more chaos. And so, let's see, creating chaos for market makers. And that I think could be really good for sending it higher, like perhaps leading to a gamma squeeze, especially if max pain's around 250 and prices going up to $5 or $10, I think that's kind of like a 4D chess move. We need to be thinking a little bit more dynamically than just buying and holding. And so, yeah, I just wanted to say thanks for the comment, for encouraging me to think more critically about my shares. And and so what I think I'm probably going to be doing is rather than, because, let's think about this. Let's say that contract, I'm not going to pull up the options and stuff because this video is way longer than I wanted it to be initially. But let's see. Actually, I'm not going to get into it because I want this video to be less than 30 minutes long. I think it's good for the YouTube algorithms. I just realized I don't really care if people watch these videos, so this video is going to be a little bit longer. But yeah, so I wanted to think about, if you're buying, shares at $2, let's say, and the premium for this contract is, let's see, 30 cents. So that's like $30. So $30, oh crap, let's see over here, $30 divided by, let's say 220, what it closed at on Friday. That's like 13.64 shares, okay? So that's not that many. Whereas with an options contract, you get exposure to 100 shares. And so, and then if price does go up to $10, and that's not talking about it going up to $10 in the next month, because this options contract that I'm talking about, expires in 2027. So this is like saying price could go up in a volatile way between now and January of 2027. I think that could happen. I could be wrong about that, as I have been many times, as we all have been many times. But I could see that happening, whether it goes up to 5 or whether it goes up to 10, as long as I have the strategy, in coming back to this, let's see, where did I have this? Not sure where I heard this, but we have to have a plan, not just for buying, but also for selling or trimming to manage risk. And so I think that getting more of these options, more of these calls, for me, everybody's different. Everybody manages stuff differently. And like for me, learning options, I'm still learning them. I still lose money on them. They're very risky, much more risky than shares. But I kind of like this because, I could get 13 shares and my share average doesn't go down. My share average is at a price where I think we could be getting back to. And and then by doing these contracts that could potentially be leading to, a gamma squeeze. And so I think that's, intriguing. Also gives me opportunity to lower my risk. And I think that's how we win. We win by playing 4D chess. We don't win by saying, our CEO is playing 4D chess. Maybe he is, maybe he's not. I think that looking at share price, I don't have a lot of, especially, in the vote that we have coming up. They're talking about board or executive compensation. Why are they getting compensated when we have not been compensated for holding shares, when we have not been compensated for having conviction, a long-term conviction in AMC when the stock has not performed? And the movies coming out from Hollywood have just sucked. I'm sorry. But yeah, I'd rather get exposure to 100 shares than 13.6 shares. And I don't want to be going down these rabbit holes, but I'm going to do it. That one contract over here, not the $3 one, I think that's too risky. This $5 one, what's the premium at? Yeah, it's like, I'll zoom in so you can see it a little better. But the premium for this one, what was the average fill? On Friday the 21st, it was 32 cents. So let's be fair with that math. $32 divided by $2.2 per share based on what it closed at. It's 14 and a half shares. And so, I could get 14 and a half shares, or risking knowing that this could be going to zero, I could be getting exposure of 100 shares for $32 based on the average from Friday. We might not see that again. It might go lower. I have no idea. But I just find that to be more compelling than just getting shares that also puts a ticking clock on it. I, would then be out of this position, this contract, well before. Don't want to be holding stuff to expiration because these things will go to zero. But I think $5 seems reasonable. I think 2027 seems reasonable. And if the chart does spike up to $10, sell, 50 to 100 to hundreds of shares, whatever I want to do, whatever you want to do. I don't care. But then from there, trim to lower that risk, and then say, hey, but I need to be accountable. I need to be accountable. I'm going to trim to lower my risk and then exercise these calls. And then that creates chaos. That creates chaos for market makers. And they let the cat out of the bag. The cork pops out of the bottle. The ball gets released from underwater. And, we start to see things go higher. And while it's not too compelling, but what I see, just over here, net call premiums going up with price going up. And so it's only 138,000, but, I think that this could be, a really, really good idea. So I really like this a lot. And that's just what I'm thinking about. I'm thinking more about that $5 strike call that expires in January over shares, because then that gives me leverage and that also gives me an exit strategy. Whether it's because the calls are going to expire and they could expire worthless, or because the intention for this strike is not to sell them for premium, but to exercise them and to sell shares to create chaos for market makers and to, let the cat out of the bag. So yeah, just want to come back to this. Thank you for the comment. Hopefully this was helpful for you guys. And let's see. Yeah, I'm just going to come down here because this is really kind of the theme for the video. 40 chests there. And let's see if I can scroll that up. Hopefully this doesn't block it. If you did enjoy, please make sure you like, subscribe, and share. I think that this could be a really good time. So I do have some confidence in that, and just wanted to share the thought process. I'm compelled by this. It's in my view, a good strategy to lower risk while also putting some heat on the stock and get it to rise some. But yeah, have a great Sunday. I've got to enjoy the day and put out some Neo and Plug Power videos. But yeah, thank you for the comment. I do appreciate it, JR. See you guys later.